It's an understatement, I think, to say that there's tremendous volatility in the value of the Australian dollar. Just last week, the dollar fell by about 3 cents, and earlier this week it's recovered by almost as much to now be about 98, 99 cents. So at the same time as all this volatility in the value of the dollar, there's a strong feeling about its strength, the strength of the dollar. The tourism, educational, manufacturing sectors of the Australian economy are almost screaming that the dollar is squeezing them. So in their view, the villain in keeping the dollar too high is the mining boom, high commodity prices, and high interest rates. So here's what are the major issues regarding the Australian dollar. Is it overvalued? Where's it headed over the longer term? Is there excessive volatility? And what role for government in all of that? And before addressing these issues directly, let's set the scene by looking at the value of the dollar over the last 3 decades. When the Australian dollar floated in 1983, it was worth about 91 cents, and almost 30 years later, it's back where it started, about 97 or 98 cents. But along the way, there's been tremendous ups and downs. It reached a lower value of about 48 cents some years ago. And there's tremendous volatility that we can see from this picture. In the upper curve is the value of the dollar. The lower curve, the one that looks like a plot of white noise, is changes in the value of the dollar. So it's a measure of volatility. And this volatility, if we look at it closely, we can see that it's increased substantially from this band here of volatility going back a little way. The yellow means caution, into red means danger sign. The volatility of the dollar has approximately doubled over the last several years. Those changes have gotten bigger and bigger. This picture shows us another way of looking at volatility of the dollar. This is a plot of changes in the dollar over a day-to-day basis. And if we look at the left-hand tail of this plot, we'll see that in almost 4% of the cases, 4% of the days, the dollar falls by 1 cent or more. So there's 4% probability of a 1 cent drop in the dollar in a day. That's huge if we think about annualising, converting from a daily change to an annual change. And similarly, at the other side of the distribution, there's about a 3% probability of the dollar increasing, appreciating by 3% in a day also. Now, if we take this picture and if we split it, this is for the whole 30 years, if we split it into before and after, we can see another way of viewing this increase in the volatility. Here's the same picture, 1983 to 2006, daily changes in the value of the dollar. And here's a picture, the same picture, for the last 4 years. And we can see from this picture for the last 4 years, there's about 11% probability of the dollar falling by 1 cent or more in a day, and about 10% probability of it increasing by one or more cent in a day. Now, someone once said the behaviour of the dollar can be characterised very simply. It walks up the back stairs very slowly and then falls down the elevator shaft, falls down the lift shaft. If that's true, then these changes in the dollar would be predictable. If it's taking its time walking up the back stairs, we could track it and see, aha, something's going to happen before it crashes. So the question is this walking up the back stairs, falling down the elevator shaft true? No, it's not. Here's a picture of the average path of the value of the dollar before it makes a big appreciation. It makes a big appreciation on day 0, big being defined as more than 1 cent increase in the value of the dollar. So what happens is that we're going along here, allegedly walking up the back stairs. It's not doing anything at all. It's about 0, 0, 0, spike, large appreciation, 0, 0, 0. So that's the large appreciation case, and the backstairs one is really this one here, but it's exactly the same story. It's the mirror image here. This large change in the value of the dollar at day 0 is entirely unpredictable. There's no advanced warning signal that this is going to happen. So we could say that to a first approximation, these changes are unpredictable, they're serially uncorrelated, so the foreign exchange market is approximately efficient for the Australian dollar. Now, yet another way of looking at the dynamics of the dollar and the volatility is saying, looking back over the past 30-odd years, what's the probability of the value of the dollar staying at above, say, 90 cents? Where we are now, more than 90 cents, about 99 cents. What's the probability of it staying there? Here's the answer. 78% chance that the dollar is going to stay above 90 cents over a 30-day horizon. So, but there's a 22% chance that it'll drop out of that band and become less than 90 cents over about a month planning horizon. Okay, let's now address the very exciting question. Is the Australian dollar overvalued? Now, this is an exciting question, but it's a difficult question. It's a difficult question, but nonetheless, I can provide some answers. Note that I use plural here, answers. And that's important for what is going to come. The true value of the Australian dollar, we can't be absolutely hard and fast on this. There's no pat answer to this, but we can have some guidance in terms of where the truth may lie. We can use the theory of purchasing power parity. PPP tells us that currencies of high inflation countries depreciate over time, currencies of low inflation countries appreciate over time. This holds over the longer term, and so the idea is that currency values are related to prices in the two countries, prices in Australia, prices in the US. We can apply the theory of purchasing power parity by using the Big Mac index, the BMI. Not the body mass index, the Big Mac index. And this has been the subject of serious research at the University of Western Australia for a long, long time now. We've had some very good PhD theses written on analysing the quality of these forecasts of currencies that are published each year in The Economist magazine. It goes around the world, asks its correspondents in about 40-odd countries, what is the price of a Big Mac in the capital city of your country? Here's the answer. In Australia, July 2011, it was $4.56. In the US, it was $4.07. PPP theory says that the currency is just the ratio of those two prices, $4.07 to $4.56. So PPP theory can be summarised in the form of this little picture. We've got the value of the currency on the vertical axis and the prices of Big Macs in the US relative to Australia on the horizontal, and this 45-degree line, that's the PPP ray. So the ratio of prices in the US to Australia, down the bottom here, is 0.89, And if we read up to the PPP ray, that gives us that the Big Mac prediction, the value of the currency, is 89 US cents compared to the current value of 99 US cents. So the Big Mac index tells us that the Australian dollar is indeed overvalued. But our research has shown that whilst the Big Mac index is entirely respectable, entirely legitimate, one can even improve a little bit more on the Big Mac index by taking out a systematic bias. Got to downgrade the economist forecast, the Big Mac index, by knocking off about 15%. So rather than a 45-degree ray coming out of the origin, which is the unadjusted body mass index curve, or Big Mac index curve, I should say, we have a curve that's got a little bit, that has a slope less than 45 degrees. And we can say that we use the same price ratio, apply that to the bias adjusted Big Mac index to give us a better, in my view, forecast of where the Australian dollar should be and where it would go over the longer term, I have no doubt, is 77 US cents. There are some qualifications to what I have to say. However, one wouldn't necessarily want to bet the housekeeping on these forecasts, I should say. Go carefully when it comes to putting out cash in currency markets. There's a few qualifications to all of this, to allow for differing incomes across countries, to allow for terms of trade changes, and most importantly, to allow for the fact that this applies not on a day-to-day basis. The Australian dollar is not going to be worth 77 cents tomorrow, I can confidently predict. Over the longer term, it'll go in that direction. Okay, let's now turn to some policy aspects of all of this. And let's first ask the question, what sort of a job does the Reserve Bank have at the moment? Very difficult job. Here's a little picture that encapsulates the difficulty that the Reserve Bank has in running monetary policy right now. Here we have the Governor of the Reserve Bank, Glenn Stevens, riding two horses at the same time, and these two horses represent inflation and interest rates. And if that's not tough enough for him not to fall off, there's some very helpful gentleman at the back here suggesting that Stevens should also try to ride a third horse, which pertains to the value of the Australian dollar. This is related to what's known in international finance as the impossible trinity. We can't have all of a fixed exchange rate, international capital mobility, and independent monetary policy. That's summarised by those three horses. That's the challenge that the Reserve Bank has at the moment. The Reserve Bank have another little challenge on their hands that some of you, I'm sure, have been reading about in the financial press. The Governor of the Reserve Bank is now billed as the $1 million banker. He's getting paid $1 million, and there's a little bit of controversy about the level of his pay. I myself think that he earns his money, but not everyone agrees. So here's a little picture that summarises the second challenge of the Reserve Bank pay rates. Now here's Glenn Stevens again, steering Spaceship Oz through some fairly challenging territory here, the global financial crisis and other meteorites. He's pulling all the levers. Here's his boss over here, Treasurer Wayne Swan, he's got a little piece of paper in his hand that can't quite read it, but I can tell you what it says. It's headed RBA pay rates. And Wayne Swan is wanting to have a little word to Captain of Spaceship Oz about how much he's getting paid and take his eye off the main problem, of course, which is steering the Australian economy through these turbulent times. Okay, what should happen to monetary policy in Australia? It's helpful before answering that question if we say a few words about what's happening in the world economy, because that impinges very, very closely on domestic economic conditions in Australia. We have a number of risks in the global economy. China continues to grow at 8-9%. There is some uncertainties about how long that can be sustained. Europe, everyone knows about, is growing at about rate 0, has these public finance problems, has these debt problems and problems associated with the euro, and we might get a chance to talk about these things in the question session. Commodity prices that have recovered substantially since the GFC in 2008, they're coming off the boil also right now, and maybe these commodity markets are being early warning signal makers of the world economy slowing. And superimposed on all of this, if that's not enough problems for the world economy, all of this quantitative easing in the US in particular, in my view, is going to lead to inflation in the US over the medium to longer term. So in short, we have huge volatility in financial markets coupled with these difficulties in the world economy, slowing world economy. So what should the Reserve Bank do about all of this? With the Australian economy also slowing a bit, although not slowing noticeably around here in Western Australia, thank goodness. In Australia, we share some of those uncertainties from the global economy, but very, very much reduced. Things are much, much better in Australia than most other Western economies. The key problem that the bank faces, the Reserve Bank faces right now, is a balancing act between setting interest rates. If they set them too low to try to give the economy a bit of a boost now, that might lead to a spike in inflation. But if they keep them not low enough, that might exacerbate the slowing of the Australian economy. So this delicate balancing act is the problem that the Reserve Bank faces right now. And in my view, possibly what they should do, although it's by no means absolutely clear-cut, I'd have to say, possibly the bank should lower cash rates rather than increase them in the short to medium term planning horizon. Thank you very much.